Good morning. Today is Sunday, April the 16th. For those of you who celebrate it, happy, Greek Orthodox Easter. I'm not sure exactly how many different denominations of the Orthodox celebrate Easter on the Gregorian calendar, but for those who do, I guess this is your weekend, and happy Easter. And for everybody else, just happy regular old week. Thank you, first of all, for taking the time to join me. This week, things might be a little bit, shorter than usual. I don't know if I'll do the whole hour. Really, I just want to talk a little bit. I want to give a presentation, I guess you could say. Try to switch things up from how I normally do them. And this week, I'm going to give just a kind of a concise presentation about depreciation and how you can use it to be a better investor, make more money, and improve your life. And this is knowledge that is useful not only to people who, want to be real estate investors and build an empire of, 20 rental properties or 10 rental properties or whatever the dream is as far as investing goes. But this is also beneficial even to people who can't see themselves ever becoming investors, but will still own a home, maybe two, right? This information is valuable. Why is it valuable? Well, the single greatest expense that we all incur in life is taxes. That's just goes without saying, right? It's interesting. I'll go on a really quick aside. Historically, people have killed each other over taxes all the time. And historically, taxes have never, ever been this high. You will maybe watch the news media and knuckleheads online talk about how, the tax rate used to be 90-something percent. Those people are idiots. They're completely incorrect. What they're referring to is what was written down on paper. And in that regard, they may be right? The tax rate that was written on paper was 90-something percent. The reality was that this was in a world and a time and a place where computers did not exist, where digital financial tracking did not exist, and even where double entry bookkeeping was, no longer a new technology or anything, but it wasn't necessarily always being practiced by businesses and certainly by individuals, right? So we're talking about a time where the government was literally incapable of accurately assessing your income to take 90% of it, right? And so when you're in that kind of environment, you could set the number to whatever the heck you want. You're never going to collect that amount, right? Because people are going to do everything they can to hide their income from you, just like they do today. And at that time, it would have been so much easier for them to do that, right? Especially a lot of their transactions would be cash transactions. There's no paper trail. Like you're talking about a fundamentally different world. And so when people say, oh, well, the taxes used to be really, really high. Yeah, they did, but it was impossible to collect them, right? What the taxes effectively worked out to be, right? The money that you actually managed to collect from people, that's a much, much lower number than that 90%. And it turns out that a lot of economic research has gone into taxes for obvious reasons. And generally speaking, you can only collect so much, period. Because when you increase taxes, you disincentivize work. Disincentivized workers don't work, therefore they don't pay taxes, therefore your tax returns go down. So the more you squeeze, the less juice there actually is to collect. And it turns out that if you squeeze less, then people will work harder because they get to keep their stuff, which means that there's a bigger pie, which means even though you get less of it, your tax income increases to a certain point. So there is like an ideal local maximum in your equation, your function here of tax rate versus tax income. There's a local maximum where that's the ideal tax rate, basically. And if you go higher, yes, you collect a larger proportion of taxes from individuals, but a smaller proportion of individuals work to create a taxable income. And if you go lower, there's no longer enough individuals to incentivize further economic growth to grow the tax receipts. And so there's kind of this sweet spot that you want to hit. Governments around the world don't know this. They don't care. I mean, look at the people who are in our governments. They're not our best. Let's put it that way. Okay, they're not our best. The people in our society, the people who are the hardest working, smartest, most insightful, creative, empathic, etc., none of those people become government leaders. The people who become government leaders tend to be narcissistic pricks. That's who they tend to be. That's just the reality of it all over the world. It's not something that's unique to Canada or the United States or Russia. That's what the world is, right? Who seeks out that kind of power? People generally not very good people. That's just what it is. So for the rest of us, we've got to figure out how to survive and thrive in a world that is run by people who are often not our best, and we'll just leave it at that. So today I'm going to talk to you about depreciation and real estate, and I'm of course going to take a Canadian perspective. Understand, if you're listening to this from somewhere else in the world, that the concepts remain the same, although the language might change a little bit. Excuse me. I'm pretty sure all Western democracies have some sort of depreciation provision in their tax codes. I don't know about countries with more interesting property rights arrangements, like in Mexico, where you can't actually own property. I don't know if they allow you to depreciate, but I would assume that they still do. Maybe in China you can't depreciate because it doesn't belong to you, you know. But in general, depreciation is a concept that you can understand and apply pretty much anywhere in the world. And you can understand this concept on two levels. There is the tax code concept, and then there's the physical reality, because there is a physical reality, even if the physical reality and the tax code concept don't perfectly map onto each other. Right? So the beauty of real estate investing lies in its ability to provide a multitude of benefits. And one of the most powerful advantages is the potential for tax savings through depreciation. Today, we will examine how the Canadian tax code allows investors to capitalize on depreciation, creating a strategic financial advantage. My apologies. Depreciation, or as the Canadian Revenue Agency calls it, the capital cost allowance, is a powerful tool for investors to minimize taxable income, thereby increasing cash flow and overall return on investment. It is essential to recognize the value in understanding the nuances of the tax code, as it can significantly impact your financial future. Now let's dive into the mechanics of depreciation. In the world of real estate investing, the term depreciation refers to the decrease in value of an asset over time, primarily due to wear and tear. The Canadian tax code allows real estate investors to claim a portion of this decrease in value as a tax deduction each year. This deduction helps offset the income generated by the property, ultimately reducing the amount of taxes owed by the investor. There are different types of properties, and each has its own depreciation rate. Under the Canadian tax code, for example, residential rental properties fall under Class 1, with a depreciation rate of 4%. Commercial properties, on the other hand, belong to Class 3, which has a depreciation rate of 5%. It's crucial to familiarize yourself with these distinctions, as they will significantly impact your tax strategy. Let's explore some of the advantages of leveraging depreciation in real estate investments. 1, you can get enhanced cash flow. By depreciating property, investors can reduce their taxable income, which translates into lower taxes owed, and this means more money stays in the investor's pocket, boosting cash flow and providing additional capital to reinvest or cover expenses. Note, you don't actually need to be an investor to take advantage of this. If you own a property, you can depreciate it and put that depreciation against your taxable income, which means that owning real estate can allow you to earn more money before the government taxes you, even if you're not owning that real estate to generate an income or to use as an investment. 2, tax deferral. The beauty of depreciation lies in its ability to defer taxes. By claiming CCA, investors can defer paying taxes on their rental income until they decide to sell the property. At that point, the taxes will be recaptured through a process called the recapture of CCA, right? This provides investors with greater financial flexibility and the opportunity to strategically plan their tax oh my goodness, excuse me, and the opportunity to strategically plan their tax liabilities. 3, portfolio growth. The additional cash flow generated by claiming depreciation can be used to acquire more properties, further growing an investor's portfolio. This creates a snowball effect, as each new property acquired can also be depreciated, further increasing cash flow and the potential for wealth creation. As with any investment strategy, it is important to understand the potential drawbacks and risks associated with depreciation. One primary concern is the recapture of CCA mentioned earlier. When a property is sold, the CRA requires investors to pay taxes on the cumulative amount of depreciation claimed over the years up to the original purchase price of the property. This can result in a significant tax liability upon the sale of the property. To minimize the impact of recapture, investors can employ several strategies. First, you can refinance. Instead of selling a property, investors can refinance their mortgage, accessing the equity built up in the property. This allows them to pull cash out without triggering a taxable event and maintain the benefits of depreciation. 2, like-kind exchange. In some cases, investors may be able to defer recaptured. What just happened there? Something. Okay, that's fine. Like-kind exchange. In some cases, investors may be able to defer recapture taxes by exchanging one property for another of similar value in a like-kind exchange. This strategy, however, is subject to specific rules and regulations, so it is essential to consult with a tax professional before proceeding. 3, strategic disposition. Timing the sale of a property to coincide with a lower income year or a period of reduced tax rates can help minimize the impact of recapture taxes. And 4, capital gains offset. Capital gains realized from the sale of a property can be offset by capital losses from other investments. By strategically planning the sale of underperforming assets, investors can minimize their overall tax liability. Now, let's talk about the importance of proper documentation and record keeping. In order to maximize the benefits of depreciation, it's crucial to maintain accurate records of the property's purchase price, improvements, and any associated expenses. This information will be invaluable when calculating your CCA and preparing your annual tax returns. Failing to keep accurate records could lead to potential disputes with the CRA and missed opportunities for tax savings. It is also essential to work with knowledgeable tax professionals who can guide you through the intricacies of the Canadian tax code. A qualified accountant or tax advisor can help you navigate the complexities of depreciation, ensuring you're optimizing your tax strategy and staying compliant with CRA regulations. Remember, investing in real estate is not just about acquiring properties, it's also about building a team of experts who can support and guide you on your journey to financial success. In conclusion, depreciation, powerful tool that can enhance cash flow, facilitate portfolio growth, and provide strategic tax advantages for real estate investors. By understanding the nuances of the Canadian tax code and working with qualified professionals, you can unlock the full potential of depreciation and propel your real estate investments to new heights. So, my fellow investors, take advantage of the opportunities presented by the Canadian tax code and harness the power of depreciation to maximize your real estate investment returns. Embrace that knowledge, implement the strategies, and watch your wealth grow. The journey to financial freedom begins with a single step, and understanding depreciation is an easy and essential part of that journey. Remember, the rich don't work for money, they make money work for them. By leveraging the advantages of depreciating real estate under the Canadian tax code, you too can create a solid foundation for building and sustaining wealth. The future belongs to those who are prepared. So take charge of your financial destiny and make the most of the opportunities available to you. The rich don't work for money. Inspired by Robert Kiyosaki, of course. But yeah, that's a little presentation there on depreciation, depreciating your assets. It's very powerful stuff, right? If you think about taking 4% of the excuse me, 4% of the purchase price of a piece of real estate. Well, in the Canadian real estate market right now, I might buy a property that costs $1 million. That's not uncommon. So I can claim that 4% of that value was destroyed every year. That's $40,000, right? And then I can take that and I can offset my income. So now I don't actually know what the lowest marginal tax rate in Canada is. I don't know. It's like earning $20,000 or something like that, right? So I think that's the cutoff. It might be a little bit lower. It might be a little higher. Fortunately for me, it's been a little while since I was at that threshold, and I kind of miss it because I obviously, like everybody, don't particularly enjoy paying taxes. But of course, I mean, better money than that, so I can't really complain. But whatever that number is, right? Whether it's 20,000 or 18,000 or or 22, whatever the number is where your taxes start to kick in. You can imagine if you owned one of these $1 million houses, and that year you made $60,000 instead of the 20,000, where the cutoff is. If you were to claim depreciation, 4% of your $1 million property, that would be approximately, I'm simplifying for the record, but that would be approximately $40,000. And then when I report to the CRA my income for the year, I would say, hey, look, I made $60,000 at my job, but I bought this bum piece of real estate that lost me $40,000. See, it was worth $1 million, but now it's only worth 960. So I got this bum piece of real estate and it's lost all of this value, right? So now my actual income after losses and depreciation, $20,000. So you can't tax me. I didn't make any taxable income. And you could theoretically do that and not have to pay an income tax. Realistically, it would be challenging, if not outright impossible, to have like a good T4 income. That is, you're not working at like McDonald's. You have a job that is paying you well. Mind you, you could work for McDonald's and be paid well, right? But I meant like a fry cook. You don't have an entry level position, right? That's paying you kind of the minimum. It's going to be hard to avoid paying some of those taxes, just because of the way CCA is calculated. The government is not entirely foolish, even if they're not very smart. So that's something that you have to keep in mind, and that's why understanding these things is important. And that's why in this presentation, I can't just give you a series of specifics because, well, it's the nature of specifics, isn't it? They're specific, and I can't speak to your individual situation. So I can only give you the broad, the general, the bird's eye view. You need to take that information and you need to leverage it. You need to take action on it so that you can then team up with tax professionals and plan accordingly. Right? Now, where the real magic happens is, like I said, offsetting all of your income. If your income comes from a T4, right? Like you're getting a paycheck, that's very, very difficult to do this way. But you can imagine a different scenario where your income is actually coming from cash flow. And so you say, hey, I own this property. It threw off $25,000 in cash flow last year, but it depreciated $40,000. So net loss $15,000. And I actually own 3 of those. So I made $75,000 in cash flow last year, but I had a net loss of $120,000. So actually, I didn't make any money last year. You could approach the government and say that, and you could pay no taxes. That is, again, I'm oversimplifying, but that is actually something that a lot of real estate investors do. The practice is probably a little bit more common in the States just because their tax code is, America has the greatest tax code in the world. Not because it's good, it's terrible, but it is like literally the biggest. I think it might actually be bigger than all of the other tax codes combined. Like that's how crazy big it is. And I mean, the tax codes are ridiculous to begin with, right? Like nobody can understand them. How are you supposed to collect from money in a fair and honest way, collect money from people in a fair and honest way, if nobody can understand the rules you've written regarding taking money from people, which is exactly the tax code that we have. And why do we have that tax code? Well, that's really simple. That's called politics. Politicians want to lie to people and tell them that they're going to tax the rich, knowing full well that the only people with the resources to stop them from taxing them are the rich. And therefore, no matter what policy they put in place, the people who are going to bear the brunt of the burden are going to be middle and lower class people who don't have the resources to avoid those taxes. And so the tax code is this really complicated behemoth where it pretends, right? It's got all these provisions that pretend that they want to tax these particularly wealthy individuals, and all of these sub provisions that those particularly wealthy individuals can use to then avoid, defer, or defray their tax costs. And so at the end of the day, if I'm making $20 million a year, I can afford, and I should theoretically pay, let's just say $9 or $10 million of that into taxes. Well, I can afford to pay $1 million of that to hire the best damn accounting and law teams that money can buy, and have them look for all the little nitty gritty loopholes that I can use to protect the remaining $9 million that should be taxed from being taxed. And so that's how that works. Whereas if you are like a middle, let's say you're successful, even you're an upper middle class person, you make $250,000 a year household income. And so you owe about $125,000 in taxes. Yeah, if you take a tenth of that, that'd be $12,500. You could definitely hire decent accountants and maybe a lawyer to try to help you get through your taxes. But you aren't not going to be able to hire the best and look for all the little nitty gritty loopholes. And so in general, you're just going to get stuck paying most of that taxes, mostly because they're not taxing you heavy enough that it is worth your time and resources to avoid the tax. Whereas obviously if it's $10 million you're taking from me, I can think of 10 million reasons why I should try to stop you. Right. Whereas maybe you can only think of 125,000 reasons why you should try to stop them. And maybe those 125 reasons just don't rate really against the actual problem. So depreciation is fantastic. It's a very, very cool, very powerful tool that helps you to basically boost your what it allows you to do in a sense, it kind of allows you to nudge tax brackets up and down, right? Because if you are at, say, a $200,000 income, and that's the threshold to go up to the next tax bracket, right? You can buy something that has depreciation. And of course, houses are not the only things that can be depreciated. The principle applies to cars as well, when they're owned by businesses, not by individuals, and also to capital expenses like machinery for businesses and stuff like that. If you own those sorts of things, you can depreciate them as well and put that against your taxable income. And then maybe, let's say that year you go from $200,000 to $220,000 in income, which should bump you in the next tax bracket, and that extra 20 should be taxed at the higher marginal rate. Now, if you use that $20,000, let's say, to buy a depreciating asset, let's just use the example of a car. Let's say you have a business and you're doing it that way. And then that asset, mind you, a car wouldn't depreciate enough, but let's just say, right? And then that asset depreciates by $20,000, let's say. You're going to need a house in my example here, but whatever. Then you now remain in the previous tax bracket. That extra 20K didn't get taxed at the new marginal rate because you depreciated, and now your stated pre-tax income is less than the marginal tax cutoff, and so you get to keep that income. So I think that's phenomenal, right? And that's something we should all be taking advantage of. Anyways, I'm going to cut the stream here because today is Greek Easter, as I mentioned at the start. I am not Greek, but I will be celebrating with some extended family who are. So please, each and every one of you, enjoy the day and your weekend and your week, and keep learning and growing. And I can't wait to see all the amazing things that you do with this knowledge. Please let me know if there's any questions or topics that I can help you or guide you with. And I'll see you the next time.